Hamilton Enhanced U.S. Covered Call ETF, ticker symbol HYLD, is an abomination. Oh, my income. I need my income, guys. Welcome back to Strongman Personal Finance. In this video, I'm going to review the Hamilton Enhanced U.S. Covered Call ETF and why I think this thing is hot trash. First of all, let's talk about covered calls. What's a covered call? Basically, you have some kind of underlying investment, and then you trade in options where you write a contract where you receive a premium, and in return, you have the obligation, if you are exercised, to deliver your underlying investment in $100 or 100 unit lots to the person that exercises the call. Basically, you own a bunch of investments and you want to generate additional income, you would sell covered calls. So what this ETF does, well, we'll see in a sec. We'll see the underlying holdings. But the fundamental underpinning is that it has some kind of underlying investment, and then they generate additional income on top of that with covered calls. Now, there's a bunch of high-yield shills out there that love this. They love it. Oh, God. Oh, it's not income. Because they deliver you more U.S. income every month. Yeah, because I can't generate monthly income myself by having, I don't know, maybe some bonds, or maybe I could just sell some of my investments every month. I don't know. No, I need to invest in a covered call ETF, okay? So what are the highlights of HYLD? It's a big SHILL ETF by a bunch of dividend clowns. Yield of 13.6%. Oh my God. Do you see that yield? That's amazing. With monthly distributions. Portfolio of U.S. equity covered call ETFs with sector mix broadly similar to the S&P 500. Okay, you're not getting the S&P 500 with this, okay? Available for purchase in Canadian dollar hedged and USD hedged. Wow. So it gives you attractive monthly income. So basically somebody's like, oh, well, even though I'm not retired yet, because if you really think about it, are there really retired people buying this? Maybe there are some retired people that are buying this, okay? But the vast majority are probably dividend clowns that just want to see monthly income. And they feel rich because they get monthly deposits into their investment account. When in reality, you should be focusing on total return, not income. Diversified blue chip U.S. equity exposure. Oh, I could get that with the S&P 500. A higher yielding alternative to the S&P 500 with similar volatility. Okay, the yield is higher. What's the total return? What's going to make me more money? A covered call ETF or an abomination conglomeration or the S&P 500? I wonder. Enhance growth potential and yield by adding a modest 25% cash leverage. Oh, so now they're borrowing money to buy more crap. Man, that really fits with most people's investment philosophy. Borrowing a money to invest. Yeah, that's a really good idea. You know the worst that could happen? If you buy individual stocks or you buy an ETF, the worst that can happen is that it goes to zero, okay? Assuming you're not doing any other degenerate crap. The second you start using leverage, you might owe money. Your stock could go to zero in an insane scenario, or your ETF could go to zero, and you can still owe money. Leverage is how everybody gets annihilated, okay? But here you are, checking out this thing right here because it has a high yield and it pays monthly. Ooh. And even though it underperforms the S&P 500, and they're using leverage, okay? So let's go ahead and we'll pull out the fact sheet a little bit. Okay, so here it says 14.25 yields, and here it says 13.6. So I guess that's changed recently. Let's look at the expense ratio. Number one, the management fee for this poopy butt is 0.65%. 0.65%. I believe that's 20 times more expensive than VOO, the S&P 500. VOO has 0.03. This is 0.65. That's insane. You're You're paying a fortune just to get monthly income, okay? Now, the assets under assets, 245 million. I mean, that's pretty small of a fund. But basically, it's sold as a higher yield. However, let's go look at the performance. Let's zoom in here. Okay. So this is a very new ETF. So in this performance chart right here, you see on the left, they're using this sole active U.S. covered call ETFs index times 1.5. So I guess that represents the money they're borrowing, leverage, to buy investments. Good idea, guys. Has performed similarly to the S&P 500 after constituent fees. So you can see here, this index, which is not this fund, it's an index that is representing what this fund could have potentially been. You got to make sure you know that. Has underperformed the S&P 500, okay? And they have this like little snapshot here for a very brief moment in time. But think about it this way, okay? If you're selling covered calls in a bull market, what happens is if stocks shoot up, you might get exercised and you might lose your underlying investments. A covered call, you trade income for long-term potential gains. It's not a great thing to do, especially when you're young. I'd rather just own the index and in the long run, probably outperform, which we can see the S&P 500 is starting to absolutely annihilate this, okay? Then worry about getting a monthly income, and you're probably paying taxes out the butt, okay? The income doesn't matter. All that matters is, did you outperform? Who won? Did you make more money doing this? Or did you make more money buying the S&P 500? Are you better off paying a 0.03% expense ratio? Or are you better off paying a 0.65% expense ratio? Oh, and here's another thing. What if the managers of this fund make a mistake? What if they do something wrong and it absolutely implodes this fund? Because there's a lot of management and stuff that's going on inside of this thing because they're selling covered calls and blah, 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 paying dividends and blah. It's a madhouse, okay? Compare that to an index. How do you screw that up? If you're an index fund manager, how do you mess up an index? You really don't, okay? So overall, this thing is an abomination. I mean, let's see what's inside this thing. So it's basically, what it looks like to me is it's an ETF that buys other ETFs. And another concern I have, I can't confirm this right now, but it looks like, you know, there could be hidden fees, basically. Because the ETF itself, HYLD, charges 0.65. But it looks like they're investing in other covered call. So it's like an ETF of ETFs, okay? They got QYLD, RYLD, TXF, XYLD, JEPI, blah, 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 blah. Those also have expense ratios. So I don't know if they've wrapped up that 0.65 into this. Let's go look up QYLD, see what their expense ratio is. So basically, you're paying a fortune, right, to sacrifice future gains just so you can get monthly income. Wow. Okay, this is 0.6. I'm not exactly sure, but I have a suspicion there might be more hidden fees because it's investing in other ETFs that charge a management fee. I could be wrong, but whatever. But it's just like, holy freaking crap, what do you get out of this? Income? Oh, I need my income. Wow. Yeah, you could also do that with like bonds. You know, it's actually a lot better in my opinion, but whatever. So at the end of the day, this is a freaking disaster. I don't like this. I'm not a fan of this. I don't get the obsession with income. Why is everybody obsessed with income, especially when you're young? Just buy a freaking broadly diversified total market ETF and shut up instead of focusing on, oh, income. Oh my God. All right, that's it. I don't know what more to say about this. I think this is freaking garbage, and I wouldn't touch this thing with a 10-foot pole. Oh, let me pay 20 times more than VOO, and so I can underperform it. Oh, and they use leverage. Wow, great deal. And if there's a massive bull market, this thing will probably underperform because it's a covered call ETF. All right, cheers.